While owning a house in America has always been considered a symbol of success, for many NRIs, buying a second home or an investment property in states like Florida, Texas, Arizona, it was seen as one of the safest ways of building long-term wealth. The formula looks simple: buy a home, rent it out, let the tenants pay the mortgage, watch the property's value increase every single year, and slowly build wealth without doing much. Well, for more than a decade, this strategy worked beautifully. But in 2026, that story is definitely changing. The numbers are beginning to tell a very different story here. According to fresh real estate data, rental growth across the United States has slowed dramatically. In many of America's fastest growing Sunbelt cities, rents have almost stopped increasing. Some markets are even seeing rents fall here. Cities like Miami and several parts of Texas, which once attracted huge number of investors, are no longer delivering the same strong rental return that people expected it. So what happened? Let's decode that. Well, the answer takes us back to the pandemic. When remote work, it became common. Millions of Americans left expensive cities and moved to places like Austin, Dallas, or Tampa. Developers saw this growing demand and started building thousands of new rental homes and apartment complexes. For a while, everything looked perfect, but today, those newly built properties are entering the market at the same time. And suddenly, there are more rental homes than tenants in many areas. When supply increases faster than demand, rents stop rising. Sometimes they even begin to fall. That's simple economics. But falling rent, it is only half the problem here. The bigger challenge is cost of owning these properties. Many investors purchased home when mortgage interest rate were much higher. Today, they are paying 6.5 to 7.5% interest on the home loans. At the very same time, property taxes have increased. Insurance premiums, specifically in states like Florida and Texas, have become much more expensive. Maintenance costs continue to rise, and rental income, it is no longer increasing fast enough to cover these expenses. Now, this means something many investors never expected. Some rental properties are no longer generating positive monthly income. Instead of earning money every month, owners are putting their own money into these properties just to keep them running. Well, that completely changes the investment equation today. Large investment firms have already started changing their strategy. Many are slowing down the purchases in these markets and moving their money into safer financial assets that offer better returns. Individual investors don't always have that flexibility. Many remain locked into long-term mortgages and rising operating costs. Wait, does that mean the US housing market is collapsing? No, experts are not saying that. What they are saying is something different. The era of easy money in American real estate is over. Owning property is no longer enough. Investors now need to actively manage their finances, review mortgage options, challenge high property tax assessment where possible, control maintenance expenses, and most importantly, evaluate whether the property is actually generating real cash flow instead of relying only on future appreciation. And yes, for thousands of Indians who invested in American real estate, this is an important reminder. Property is still a valuable asset, but in today's market, success depends less on simply owning home and more on managing it wisely.